I want you to imagine, just for a second, that you own the only functional, like, high-speed toll road leading right out of a major industrial city.
Okay, I'm picturing it.
Right, so you've owned it for years, the margins are super steady. But suddenly, overnight, the main coastal highway just completely collapses.
Oh, wow. Total chaos.
Exactly. Utter chaos.
Yeah.
Every single shipping truck, every commuter, all the supply lines they still need to get out of the city. And your toll road is literally the only reliable, secure option left on the map.
Which creates, this position of immense unexpected leverage. I mean, you didn't cause the highway to collapse, but you hold the only viable physical solution to a massive crisis.
Yeah.
And the value of your asphalt basically just went through the roof.
Right. And that exact scenario, that is exactly the situation that North American energy infrastructure finds itself in right now.
It's wild to see it play out in real time.
It really is. We are looking at a fundamental rewiring of how the entire globe sources its power. So to understand the sheer scale of this shift, we're doing a deep dive today. We're dissecting the May 8th, 2026 Q1 earnings report, the slide deck, and the actual executive conference call transcript from Plains All-American Pipeline, or PAA.
Yeah, and we're not just, reading off a spreadsheet today.
No, definitely not. Our mission is to really decode how massive global geopolitical shocks translate directly into infrastructure strategy, corporate cash flow, and even localized bottlenecks down in Texas.
Yeah,
We're taking this from the macro map straight down to the balance sheet.
exactly.
Okay, let's unpack this, because I know we need to start with the high-level global overview before we get into PAA's specific Q1 results, right?
Yeah, we absolutely have to look at the macro environment first, because literally everything in PAA's financial guidance right now flows downstream from what's happening in the Middle East.
Right.
So over the last few months, the Strait of Hormuz has essentially been closed due to the ongoing conflict.
Which effectively pinches shut one of the most critical arteries for global shipping in crude oil.
Exactly. And the market reaction to that has been, well, it's been intense.
Oh, massive. We're seeing excess floating storage just being completely drained all over the world. And nations are heavily tapping into their SPRs, their strategic petroleum reserves, just to keep their domestic economies functioning at this point.
Right. They're basically breaking the emergency glass on a daily basis. And on the PAA earnings call, CEO Willie Chang, he categorized this current state of the market as a massive destocking phase.
Destocking.
Yeah, and understanding the mechanics of that destocking is crucial to seeing PAA's long-term upside. Because, the global market is surviving on reserves right now, but that creates this coiled spring effect.
Wait, how so?
Well, eventually the conflict stabilizes, right? And every single nation that drained its SPR is going to have to restock those barrels, probably at even higher levels than before the war. So you have this massive guaranteed layer of future demand just waiting out there.
Okay, but I'm looking at this destocking trend, and I have to challenge the optimism here a little bit.
Sure, go ahead.
If everyone is just draining their emergency tanks right now, isn't that just like putting a bucket under a leaky roof? I mean, how does a temporary fix, a temporary reliance on emergency reserves, fundamentally change the structural long-term value of PAA's existing pipelines?
That's a great question. But if we connect this to the bigger picture, the shift isn't just about the volume of the reserves. It's about a permanent reassessment of risk.
Okay, risk.
Right. The instability in the Middle East is forcing nations to price in this geopolitical risk premium that they honestly just completely ignored for the last decade. Post-war OPEC production capacity is a huge unknown right now.
Because of the infrastructure damage.
Exactly. Shut-in production takes significant time and capital to recover, and damage over there is highly likely. Therefore, the global reliance is permanently shifting toward jurisdictions with secure, predictable rule of law.
So North American supply basically transforms from just an economic arbitrage play into an absolute baseline strategic necessity.
Spot on. And we have to remember the physical reality of this industry. Building new pipelines in North America is, it's incredibly difficult.
Highly litigious.
Highly litigious. And it takes literally years. So the infrastructure that operators like PAA already have physically buried in the ground becomes exponentially more valuable. I mean, the replacement cost of their network has completely decoupled from its book value.
Because you almost couldn't replicate it today, even if you had the money and tried.
Exactly.
Okay, so the toll road is built, the asphalt is dry, and the whole world is lining up. But looking at the source material, this brings up a really glaring contradiction, a massive bottleneck that we really need to talk about. The Permian paradox.
Ah, yes. The behind-the-pipe mystery.
Right. The analysts were really zeroing in on this during the call. Because if North American crude is suddenly the world's secure geopolitical lifeline, it makes zero sense. The PAA management just stated they expect Permian Basin production to stay relatively flat for all of 2026.
Yeah, they're modeling around 6.6 million barrels a day.
Which is crazy. If the global market is starving for secure barrels and prices are elevated, why isn't the Permian just aggressively pumping more volume immediately?
Because the system in the Delaware Basin is currently severely throttled, but, and this is the key, it's not throttled by a lack of crude oil.
Right.
It's a highly specific logistical bottleneck driven by associated gas. Currently, there are roughly 200,000 to 300,000 barrels a day of flush production sitting fully developed but physically trapped behind the pipe.
Okay, let's break down the mechanics of that for a second, because here's where it gets really interesting for anyone watching this space. It's basically like having a warehouse packed to the ceiling with your best-selling high-margin product, the crude oil. But your delivery trucks literally cannot leave the loading dock because a completely different lower-margin product is blocking the driveway. And you are strictly forbidden by environmental regulators from just throwing that cheap product into the dumpster.
That is a perfect analogy. That lower margin product blocking the driveway is the natural gas.
Yeah.
When operators drill down in the Permian, they're primarily targeting oil, but the geology dictates that natural gas just comes up with it. It's associated. And you cannot legally flare that gas at scale anymore.
So you have to pipe it out.
You have to route it into a takeaway pipeline. The problem is the entire region's natural gas takeaway capacity is just completely maxed out right now.
Which completely distorts the local pricing. I
Yeah.
mean, we've seen the Waha spread the local price for natural gas in West Texas literally go deeply negative.
Yeah, negative pricing.
Yeah.
Which means producers are literally paying off-takers to haul their natural gas away.
Wow.
They are taking a deliberate financial loss on the gas just so they can keep the oil flowing because the crude margins are high enough to subsidize that loss.
But eventually, even the off-takers run out of physical pipe space, right?
Exactly. Once those gas pipes are totally full, the producer is forced to shut in the oil well entirely. They physically cannot produce the crude without a home for the gas.
So all that productive capacity is just sitting there, coiled and ready, but the driveway's blocked.
Right. But management did note on the call that relief is imminent. New gas egress projects are coming online later this year, which will unblock that driveway.
So the bottleneck is absolutely temporary.
It is. But there's actually a secondary pricing mechanism keeping that flush production sidelined right now, too. Producers are closely watching the back end of the crude oil futures curve.
Oh, the long-term price signals, rather than just the immediate front-month panic from the war.
Exactly. Producers have learned their lesson in previous boom and bust cycles. Near-term prices are super high right now due to the Hormuz conflict, but adding a drilling rig is a massive multi-million-dollar capital commitment.
You don't just deploy stacked rigs for a 2-month price spike.
You really don't. Operators are waiting for the back end of the curve to show sustained support. They're targeting $75 or more for WTI in the out years before they pull the trigger on major capital expenditures.
Makes sense. So when those two factors align, the new gas takeaway capacity opening up, combined with a sustained long-term crude curve, that 200,000 to 300,000 barrels of trapped flush production is going to immediately flood the market.
Yes. And all of those new barrels will flow directly into PAA's existing gathering and long-haul infrastructure. It fundamentally sets up 2027 to be a blockbuster year for their crude segment.
Which perfectly contextualizes the massive corporate pivot that PAA is executing right now. I mean, they can clearly see this wave of crude volume building on the horizon, and they're radically restructuring their corporate identity to catch it.
They really are. They're transitioning into a pure-play crude midstream entity.
Right, by selling off their Canadian NGL natural gas liquids business to Keyera for approximately $3.3 billion. And they expect to close that in May 2026.
Yeah, it officially strips away the NGL distraction and aligns their entire corporate focus with their highest margin, highest growth crude assets.
It's a deliberate streamlining exactly when crude infrastructure is commanding a massive premium. And we need to pause here. We need to look at a glaring red flag from the transcript that the earnings call just seemed to aggressively gloss over.
Oh, you mean the antitrust lawsuit?
Yes. The Canadian Competition Bureau is actively suing to block this Keyera transaction. Yet, on the call, Willie Shang basically told the analysts, hey, we're closing in May anyway, and flat out asked them not to ask questions about it.
He did, yeah.
Isn't that incredibly risky? just dismissing a federal antitrust lawsuit as background noise.
What's fascinating here is, on the surface, it definitely looks like hubris. But if you dig into the mechanics of Canadian regulatory review and the specific footprint of these assets, the confidence actually makes structural sense.
Okay, how so?
Well, antitrust concerns in midstream deals usually center on highly localized concentration, specifically fractionation capacity in places like Fort Saskatchewan. Keyera and PAA likely modeled this exact legal challenge into the deal structure from day one.
Oh, I see. So you're saying they likely have, like, a carve-out or a divestiture plan already baked in for the specific overlapping assets.
Exactly. A carve-out that allows the bulk of the $3.3 billion deal to proceed regardless. Plus, you have to factor in severe termination fees that heavily incentivize both parties to fight through the friction.
Okay, so the market is pricing in a high probability of closing because the financial engineering driving this transaction is just too vital for PA's balance sheet for them to walk away.
Absolutely. I mean, the debt reduction alone changes the entire risk profile of the company. They're taking roughly $3 billion of that cash and immediately sweeping it against their debt stack.
Paying down term loans, clearing commercial paper, retiring maturing notes.
All of it, which drops their leverage from 4.1x down to approximately 3.5x. Yeah, it pushes them straight into the low end of their target leverage range, giving them a fortress balance sheet just as the macro environment reaches peak volatility.
But the truly fascinating piece of this carousel, and I was geeking out over this in the source material, is how PAA protected the proceeds from the IRS.
Oh, the tax shield. It's brilliant.
It really is. Usually when a master limited partnership sells a legacy asset for $3.3 billion, the capital gains trigger a massive tax liability that passes directly through to the unit holders.
Right.
And the company is often forced to issue a special cash distribution just so investors have the liquidity to pay their sudden tax bill. And obviously, every dollar sent out as a special distribution is a dollar that can't be used to pay down that debt.
Yeah, the tax leakage on these mega deals can absolutely destroy the underlying debt reduction thesis if they aren't structured perfectly.
Yet management confirmed they won't need a special distribution. And it's all because of the Cactus 3 pipeline acquisition they made previously. By acquiring Cactus 3, PAA absorbed massive new physical assets. And under the tax code, they were able to capture a massive step up in basis. They essentially generated a mountain of paper losses through accelerated depreciation on Cactus 3. And now they are legally applying those paper losses to completely offset the real multi-billion-dollar cash gains from the Keyera sale.
It perfectly insulates the unit holder. They utilized MCRS, the Modified Accelerated Cost Recovery System, on the Cactus assets to front-load the depreciation.
It's basically a structural tax shield they build months in advance.
Exactly. It highlights a management team that is not just, operating pipelines, but actively engineering the balance sheet to retain every single dollar of value from asset rotation.
Okay, so keeping all of this in mind, the macro destocking, the Permian bottlenecks, the antitrust suit, the tax shields, let's bring it all down to the actual Q1 scorecard.
Right.
How did these overarching themes actually hit the income statement in the first quarter?
Well, it was a messy quarter on the surface, but structurally, it was highly resilient. Q1 revenue came in at $12.47 billion, but PAA technically missed consensus EPS by 2 cents.
Right. They reported $0.39 actual versus $0.41 expected.
Yeah. And if you just read the headline, an EPS miss usually triggers a sell-off. But diving into the segment broke down, the crude EBITDA took a $49 million hit that was almost entirely driven by external anomalies rather than, operational failure.
Like the weather.
Exactly. You had severe winter weather events in the Permian that physically froze wellheads and forced temporary shut-ins across the entire basin. You also had scheduled system maintenance compounding those volume drops. But the most interesting drag on the crude segment was the timing of MVCs.
The minimum volume commitments. So what does this all mean for you as an observer? Let's demystify MVCs for a second. Think of an MVC basically like a corporate gym membership.
That's a good way to put it.
The oil producer signed a long-term contract saying they'll pay PAA a monthly fee for pipe space, whether they actually ship oil or not. In Q1, freight was just too expensive because of the Hormuz conflict, so the arbitrage window closed and nobody shipped.
Right, the oil was shut in.
But PAA still gets paid eventually. The producer didn't show up to the gym, but the monthly fee still hits their credit card.
Exactly. And the critical nuance here is that the revenue hasn't vanished. Due to accounting standards, the recognition of those MVC deficiency payments often just shifts to the following quarter when the invoices are fully settled and the makeup rights expire.
So that $49 million hit to crude isn't lost capital.
No, it's deferred capital. Meanwhile, the NGL segment, which is the exact business they are selling to Keyera, actually overperformed by a massive $45 million.
Wow. In one quarter.
In one quarter, driven by two distinct factors. First, they saw incredibly high border flows from Canada. Storage capacity in Western Canada was hitting its physical limits, forcing producers to aggressively export volumes south through PAA's Empress system.
Just to clear out the tanks.
Exactly. And second, the fractionation spreads were incredibly strong.
The frac spread, meaning the profit margin generated by separating the raw natural gas stream into distinct high-value liquids like propane, butane, ethane.
Right. The wider the spread between the cost of the raw gas feed and the market price of the separated liquids, the more money PAA prints at their fractionation facilities. So those wide spreads, combined with the volume surge from full Canadian storage, resulted in a blowout quarter for the segment right before it gets handed over.
They are literally handing over the keys at the absolute peak of the asset's performance.
It's perfect timing.
Which really brings us to the ultimate signal from this whole earnings call. Because despite the severe weather, despite the shipping bottlenecks, and despite missing the headline EPS estimate by 2 cents, PAA aggressively raised its full-year 2026 adjusted EBITDA guidance.
They did. They bumped the guidance up by $130 million to a midpoint of $2.88 billion, and they're projecting an adjusted free cash flow of $1.85 billion for the year.
That is an enormous statement of confidence.
It really is. Management is clearly looking past the Q1 weather anomalies, and they're seeing tariff escalators kicking in, spot volumes rising, and operational optimization opportunities accelerating.
The underlying business is just firing on all cylinders. And once that $3.3 billion cash injection from Keyera clears the balance sheet of all that legacy debt, PAA's free cash flow generation becomes a massive weapon.
Oh, absolutely. They will have the flexibility to aggressively pursue unit buybacks, increase the distribution, or even fund organic expansions in the Permian without needing to tap the capital markets at elevated interest rates.
Right. Let's pull all these threads together, because this single earnings report captures a massive industrial pivot. PAA has navigated a quarter battered by freezing temperatures in Texas. They're currently staring down the barrel of federal antitrust litigation in Canada, and they are operating right in the epicenter of a global supply chain shock triggered by the Middle East.
Yet they are emerging from all this volatility significantly leaner, their leverage is vastly reduced, their tax liabilities are shielded, and they have successfully transformed into a pure-play crude operator.
Right at the exact historical moment that global strategic reserves are running on empty, and international buyers are absolutely desperate to secure reliable North American supply.
It's honestly a masterclass in macroeconomic timing. I mean, they built the massive physical infrastructure over the last decade when capital was cheap, they cleared the debt off their balance sheet, and now the geopolitical reality of the market is coming directly to them.
Which leaves us with a final, slightly provocative thought to chew on as we wrap up this deep dive. We spend so much time analyzing midstream companies purely through the lens of their pipeline tariff fees, their yield, their distribution coverage ratios.
Standard financial metrics.
Right. But if the conflict in the Strait of Hormuz proves that Middle Eastern supply can literally vanish overnight, and if North American pipelines are structurally the only reliable fallback for the global economy, should we stop valuing companies like PAA just based on their pipeline tariff fees?
Oh, that's interesting.
Are we fundamentally mispricing the asset class? Because perhaps these private midstream companies are rapidly becoming the equivalent of physical strategic reserves for the globe.
It raises a vital question about how markets value risk. Because if energy security equals national security, these private midstream companies are rapidly evolving beyond just simple utility-like toll operators.
Exactly.
They're effectively functioning as the physical strategic reserves for the entire globe.
And if the world absolutely requires that secure barrel of oil just to keep the lights on, the steel pipe in the ground is just as vital as the barrel itself. The broader market might not have even begun to price in the geopolitical premium of having reliable North American infrastructure already permitted, already built, and actively flowing.
Because when the coastal highway suddenly collapses,
the person who owns the only high-speed toll road out of the city isn't just a business owner anymore. They're the lifeline. Thanks for joining us on this deep dive.